For 25 years, ADA has been implementing projects with local partners in Africa, Latin America and Asia to meet the specific needs of vulnerable people. ADA's new roadmap promotes inclusive, sustainable and innovative finance. ADA empowers 3 target populations with its expertise in inclusive finance. Firstly, young entrepreneurs. Secondly, small family agricultural and forestry businesses. Finally, vulnerable households. ADA, a driver of partnerships and innovation, strives to improve their living conditions. More information on our website, ada-microfinance.org.
So that's the advert done. Thanks for taking the time. I didn't realize we had such slick videos at ADA. We didn't have them before. Welcome, come in. So my name's Matthew Genazzini. Welcome to this session on strengthening agricultural value chains and linking them TA with investments. I work for ADA, as I mentioned. I coordinate a program called the Smallholder Safety Net Upscaling Program. It's a bit of a mouthful, but in short, we call it SNUP. And essentially, the program aims to strengthen the resilience of smallholder farmers, strengthen the value chains within which they operate, and also promote investments within the agricultural sector. And we aim to do that. Hi, Asia. We aim to do that by providing funding for TA projects of impact investors. And this is why we have on our panel a few impact investors who are partners of the program. If you look at the agricultural sector in developing countries and you look at the GDP, the agricultural sector contributes enormously to the GDP of these countries. But then if you compare the amount of investments going into the agricultural sector, it really doesn't match up. So what we're aiming to do is really by providing TA through these impact investors, we want to not only de-risk the investments that they've already put into the agricultural sector, but also promote additional investments. And you know, I'm a firm believer that when you combine investments with TA, you can have a multiplier effect in terms of impact in the field. And so today, we've got actually 4 panelists. You can only see 3. The other one's online, who's Jean-Marc from Alterfin. We've got 3 investors, so Incofin, Grameen, Crédit Agricole, and Alterfin. And then we've got Daphne from Crédit, who's going to give us the perspective of a TA provider. Now, just to begin the session, I think it's nice to set the scene a little bit, and I'm going to set 2 scenes for you. The first scene that we're going to set is the scene in terms of the challenges in providing financing to SMEs in the agricultural sector. And the second one, we're going to look at the challenges with regard to financial institutions. So I'm going to ask to change to Jean-Marc, who's going to tell us a little bit more about SMEs in the agricultural sector. Please come in. Jean-Marc.
Thank you, Matthew.
Yes. Go ahead, Jean-Marc.
Thank you very much, Matthew. Thank you all. Good morning to everyone. Apologies for not being physically present with you, but I'm hoping we're having a good conversation. So first of all, setting the scene. I'd like to start by the sheer size of the challenge. The need of financing for agriculture SMEs has been estimated as being in excess of $250 billion a year. And of that need, only 25% is met. That means that 75% of that need is unmet, whether it's by formal or informal financing actors of the sector. And if you look at, if you differentiate basically the financing needs for short-term, like working capital, and long-term, like CapEx, then the ratios shift even more. you have even more unmet needs in the long term, which indicate that what you have in this sector are structural issues, ongoing structural issues, because we don't invest enough in the capacity production. And if you then look at value chains themselves, and you differentiate between what we would call formal value chains, such as coffee and cocoa, and informal value chains, then the shift is even greater. The unmet need goes close to 90%. 90% of the financial needs in loose or informal value chains are currently unmet. Now, we have to go back to the concept of by Oxfam, I think, in one of the publications back in 2009. So the missing middle is that gap between the $10,000 and $1 million financing needs of agri-SMEs. And that gap is currently not met, not addressed by local microfinance institutions because these needs are too high for most of them. They're also not met by local financing institutions, local banks, because these needs are too small for them, or the capacity of agri-SMEs to bring in collateral is not achieved. Therefore, what you find actually some of that need is currently met by what we call social lenders, and organizations such as Alterfin, Incofin, Grameen, or Crédit present in this panel are part of the social lenders. But together, we don't, of course, fill in the gap. And that gap is even greater when you look at specific risk factors. So I was asked actually to not to bring too many slides, and I've got one slide to show you. Matthew, if you could kindly share it with the audience.
It's up.
Fantastic. Okay, so what do we see here? Well, green is good, and pink, as you can imagine, is not good. Roughly, this is a data set that was collected over the span of 5 years amongst 12 organizations, part of CSAF, the Council for Smallholder Agriculture Finance, and Alterfin is one of the founding members of CSAF. So what we did is we gathered together our data. It was collected by Dalberg and analyzed, and they looked at all these loans that we made. And then kind of came up with a profiling of the average loan. So if you have a 12-month fully drawn working capital loan of about $500,000, okay, and you look at it
Jean-Marc,
as being...
Jean-Marc, sorry, we just got interrupted by an announcement. Could you just go back 30 seconds?
Yes, of course.
Sorry.
Okay, so no problem at all. So this data set was collected by Dalberg amongst 12 organizations part of CSAF. We have thousands of loans here spanning over 5 years. And Dalberg looked at what would be a 12-month $500,000 loan, so just in the middle of the missing middle. And of course, when you map it out, you see that such an average loan, if it's made to a borrower in the rest of the world, an existing borrower, okay, so if it's a renewal loan, and if it's made in a value chain, in tight value chain, such as coffee or cocoa, then typically that loan is profitable, okay? So you can see that for that loan, the net return is about $17,000. And if you're then looking at going to the right, so you're going into further risk sectors. So first of all, instead of the rest of the world, you look at such a loan to a sub-Saharan existing borrower in a tight value chain, then you can see that this kind of breaks even. It's not making much money. If you're looking at a sub-Saharan borrower, which is a new borrower in a tight value chain, it's a loss-making loan. And if you're looking at a sub-Saharan new borrower in a loose value chain, so outside of the more established coffee and cocoa transactions, then it's deeply losing loan. And that's, of course, that's the challenge that we have as lenders. I'm talking about all the active lenders in this sector. But do not let this depress you. There are some solutions, and we will talk about some of these in this conversation.
Thanks, Jean-Marc. I think that's a good kind of picture of the challenges and the gaps that really kind of live in the investment side of things. Violette, let me come to you, and can you tell us a little bit about the challenges that financial institutions face when trying to invest in the agricultural sector?
Sure, thank you, Matthew. I don't know if we can switch to the next slide, please. Great, thanks. So just setting the scenes in terms of the challenges that FSPs are facing in terms of raising funding and, serving smallholder farmers. Of course, the first one and very obvious challenge is the inherent credit risk that is linked to financing rain-fed agriculture, which is exacerbated by the effects of climate change. So what we see is that there will be a huge need from the clients and for the FSPs to cover this risk through schemes such as insurance or guarantee mechanisms. But what we see is that they can be complex to put in place, and also they can tend to be quite expensive. Then a second challenge we see for FSPs is that when you want to finance smallholder farmers, you also have to often strengthen the value chains to manage risk. And this is going back to Jean-Marc was saying also for the SMEs. So what we see is that MFIs and their clients are generally lacking links with input providers, with off-takers. And so if you don't work on those aspects, you also have increased risk. What we also tend to see is that MFIs often serve smallholder farmers through their traditional product suite. So they don't really have, some of them don't really have a dedicated agricultural loan, and rarely they have products adapted to specific value chains, which can also be a challenge in addressing the specific needs and the risks of these value chains. And also we see that there is a need to strengthen expertise on agriculture within the FSPs. Often FSPs don't really have agronomists within their teams because that's of course a cost. So it's, of course, more difficult to capture the specific risks of the value chain without this expertise. And thank you for changing the slide. So in terms of operational challenges that we see, of course, the long distances in the field to serve smallholder farmers. So there is a huge need to digitize the operations, to develop digital channels to serve clients. But all of these, of course, also has a cost. We see also that there's a strong need to provide non-financial services for clients. So technical trainings on agricultural best practices, climate smart practices, and these, once again, can be costly to integrate for FSPs. And last of all, a challenging point is that there are limited margins on agricultural activities on the client side. So integrating all these solutions that I mentioned previously, might it be insurance, guarantee, non-financial services, can also be challenging for this reason. But here again, I hope, I know we're gonna talk about solutions to meet these challenges.
So thanks, Violette. So now that we've kind of set the scene a little bit, I think what I'm getting from both those presentations is there's great risks for anyone wanting to enter the agricultural sector, whether you're an MFI, whether you're an SME, whether you're an investor, and I think in order to mitigate some of those risks, TA can play a real major role in mitigating those risks. And maybe Magdalena, I'll come to you now as probably the largest investor on this panel. For you, I know that Incofin often combines investments with TA, and what are the benefits that you see combining these two elements. And if I could be a little bit controversial, is TA like more? Is TA more like a carrot to attract potential investees, or is it used differently?
Thank you, Matt. So, of course, our investment managers are always happy to tell our prospect clients that we have a TA department at Incofin and that they could potentially benefit from support. But they can never guarantee that the client will receive TA, since the capacity to provide TA cannot benefit all the clients of Incofin. So it's something, I think, more that shows that the company is committed beyond just investment, and that brings me to, like explaining what is the role of TA at Incofin. And basically, it's one of the pillars of what we call a capital plus approach. So the idea is that through TA we can bring added value to our clients, to go beyond just provided funds, to developing tailor-made projects that build their capacity. And I would say there are three main reasons that motivate us to combine investment with TA. So the first one is, as our previous speakers have said, providing financing to agricultural value chains can be risky. So TA can be a way to de-risk the investments or make the businesses we invest in more sustainable. And when our investment managers go to the due diligence process or during the investment committees, whenever we identify there's a particular aspect of the institutions we're going to invest in that is weak or that could be enhanced, like risk management or governance, then TA is suggested, and we kind of take it up from there and discuss with the client how to strengthen those areas to make sure that the business is going to be sustainable in the long run, which ultimately is going to help us get our money back. But I would say the main goal for us is to maximize the social and environmental impact of our investments. So we like to partner with clients that, for example, MFIs who want to develop specific products for the agricultural value chain, but are not sure how to go about, mainly because they lack the capacity that Violette mentioned sometimes is needed to provide this kind of financing. So we can partner them with experts in the agricultural area that will help them develop tailor-made products with the corresponding processes and methodologies that are going to make these products financially viable, responsible, sustainable. Also for agricultural organizations directly, we can help them, for example, adapt to climate change, and I'll give a couple of examples later. So in that sense, we can make sure that our investments are actually producing impact on the end client and long-lasting impact. And maybe the last goal, which is more emergent, let's say, it's the fact that we can also support better reporting or data collection methodologies to better track our impact on the field. So we've also got a couple of projects where we support either MFIs in outcomes measurement or agricultural organizations. We want to support them in better tracking their environmental impact. So, as you see, TA is really something that maximizes the impact of our investments and that makes them be more successful in the long run.
Like an integral part of your activities. Daphne, as the only TA provider on the panel, maybe my question to you is, when you're designing TA projects, do you take into account the investment side of things? And if so, how do you do that?
Yeah, thank you, Matt. So, as you said, like, we're the only international NGO on this panel, and we have a very different role in strengthening agricultural value chains. So we do capacity building on different type of levels. So we work with MFIs, we work with governments, we work with producer organizations and farmers themselves, with SMEs. So through our sustainable livelihoods or private sector development programming worldwide, we've seen that strengthening actors within these value chains works best, of course, when combining capacity building with investments, because, of course, what will a farmer group or organization do with an improved knowledge on, for example, climate-smart irrigation when this group does not have the access to the funds to acquire that hardware or the improved seeds. However, if you're looking at value chain strengthening, we believe that development programming should deliver capacity building and marketing activities for different actors in the same value chain simultaneously. This is also, I think, what Violette mentioned. Because what will a farmer do when he has an increased produce and its off-takers are hard to find or are unable to take off all his produce? And we look at value chains and see that there are, of course, different type of interventions needed, and access to finance is, of course, always one of them. But before we would design any development programming, we would, as Crédit, we would look really into the market and really look into the market system with a market assessment. And this will help us inform which value chains we could tackle in terms of growth potential. So once this value chain has been selected, really proper individual assessments of SMEs, of producer organizations, of MFIs will be conducted. And these assessments will then really focus on the capacity, such as like the internal management, the financial management, sustainability, production base, you name it. So it's a really hard assessment. And at the same time, we do a subjective analysis of organizational commitment and potential. So together with local value chain experts, with an emphasis on local, action plans to address these gaps and weaknesses that will be identified through these assessments will be developed for each organization. And through this, like a program will be demand-driven and tailored to the specific needs and context of the producer organization and farmers in which they operate. So one of our flagship programs in value chain development is our STARS project. It's a 5-year project, and STARS is short for Strengthening African Rural Smallholders. We're not having slides yet. So it's an 18 million project that featured a market systems approach, which I will elaborate a bit later on. It's in 4 countries: Rwanda, Senegal, Burkina, and Ethiopia. So, but to come back to your question and do you consider investments within this type of programming? Sure. So, for example, in this project, it's 18 million. We invest almost a third into 22 MFIs. But the interesting part here is that, working within these value chains and working with farmers or producer organizations, these organizations, they mention, yes, access to finance is one of the most valuable interventions, but it comes often after access to inputs, which is sometimes linked to access to finance, not always, and market linkages. So it shows that an increased access to finance is in and on itself not enough for value chain strengthening, and that's why we're looking at it with a holistic approach.
So thanks for that. I mean, so there's really kind of different levels of the support that you do. So one of the challenges that we have within the program that we coordinate at ADA is to create that linkages between the TA and the investment. And you talked, Magdalena, you talked about tracking that, and it's something that we try and do, try and track it. And we're going to go to 2 examples now that they're not purely TA projects. They're more kind of innovative solutions that have been created to enable more investments or investments to have a higher impact in the agricultural sector. So I'm going to pass over to Jean-Marc, who's going to take us through, introduce us to the ESSELI program which is a program that's, if I'm not mistaken, is active in East Africa. Jean-Marc, I'll let you take over. Jean-Marc?
Hi there.
Hi, Jean-Marc. So, did you hear what I said?
Absolutely.
Okay.
Yes. So we talked about the issues, and now let's look at the solutions. So, of course, technical assistance is very important. But what I think is also interesting with ACELI, and ACELI is an initiative that span out of CSAP and received funding support from various organizations such as USAID, the IKEA Foundation, the Dutch Ministry of Finance. ACELI initially looks at some East African countries because, as you saw from the data set that I shared, it's in this region actually that the loans to agri-SMEs were most challenging from an economic point of view. And therefore, what it is providing is two things for the time being. The first one are subsidies that constitute a first loss guarantee. And the second one are subsidies for the origination and what they call origination incentives. The third solution that should be brought at a later stage is technical assistance support. Now let's look at the first two that are currently being provided to a number of lenders. And when I mean a number of lenders, I'm talking not just about social lenders such as ourselves on the panel, but also local financial institutions that have become part of the ACELI program. So in countries such as Tanzania, Kenya, Uganda, or Rwanda, these lenders can apply to these subsidies. There are eligibility criteria, of course. And what these subsidies are doing, if we take the first one, the one for first loss coverage, it's relatively small, okay? It only represents about 2 to 8% of the total loan. So you could say, okay, this is not really effective. It's not a first loss coverage that's going to improve my return on capital. And that's true. The only thing is that ACELI has made this feature as a cumulative first loss reserve. In other words, the more you originate loans, and if these loans are repaid, the first loss doesn't go back to ACELI. It stays in an escrow account for the benefit of the lender, but can only be in touch once you have a loss. And that means that over time, as you go through cycles of lending, and you lend to various partners, and they pay back their loans, you don't experience losses. So you build up a reserve account, which then will represent an increasing proportion of the next loan. So it's a very smart system because it's a way also to leverage the resources made available to ACELI by its stakeholders. The second aspect is also key. It's the origination incentive. That one is recognizing the fact that to send a loan officer in the field to perform a due diligence for 2, 3, 5 days will cost exactly the same amount of money, whether she or he is due diligencing a borrower for $100,000 loan or for $1 million loan. But obviously the returns are not the same. And as you could appreciate from the data set I shared, even at $500,000, in sub-Saharan Africa, for most of the cases, you're not making any money. So this is one way of addressing that by subsidizing the cost of due diligence and incentivizing lenders such as ourselves to go out and do that. After 3 years of existence of ACELI, that's exactly what happened for us. In the first year, which corresponded to 2020, also the year of the pandemic, we started a lending program to some small cooperatives and agri-SMEs in Rwanda, involving hundreds of coffee smallholder farmers. And the average such loan was about $125,000. That's really tiny. We disbursed actually $1.5 million on that program, and in 8 loans. So you can imagine 8 different due diligences. Without the origination incentive provided by SLE, that operation would have been economically unfeasible. Thanks also to the first loss buffer and to some other guarantee program that we have in-house, we managed to convince our investment committee to proceed with all these proposed loans. So far, we have entered the 3rd cycle of lending. We've had only 2 defaults, one that was more of a technical nature and that was solved, the other one that was a little bit more difficult, but that was repaid after extending the grace period. And therefore, we've had no losses whatsoever on borrowers that in the first instance would basically be deemed as unfeasible given the size of the loans and the original return on capital. So that's one example of how you can shift things and make these unprofitable loans interesting.
Thanks, Jean-Marc. So it's an example of how, with available funds, they're incentivizing investors to go lower, to invest further into the agricultural sector. The second example that I want to show you is called the sustainably linked loan, and this shifts the incentives from rather the donor, but shifts the incentives to the investee. And I'll let Violette present that.
Yes, thank you, Matt. So. As you introduced previously, what I'm going to present is not directly linked to strengthening agricultural value chains, but it's, I believe, an innovative scheme that we could use in general to push and help FSPs to deliver services and products with a high impact for end clients. So what I'm presenting right now is a sustainability-linked loan that the Grameen Crédit Agricole Fondation and or affiliate bank in India, Crédit Agricole CIB, have granted to Annapurna Finance. It's a leading Indian non-banking finance institution. And so we've provided together a loan equivalent to 4.5 million to Annapurna. And it's the first microfinance institution in India to sign such a sustainability-linked loan. So what does it consist in concretely? So the loan is aligned with the sustainability-linked loan principles, and basically the transaction terms we have with Annapurna include sustainability margin adjustment mechanism. So basically bona fide interest rates, which depend on whether or not Annapurna will meet annual targets on KPIs that we've defined together. So in this case, as I mentioned, the KPIs are not linked to agricultural value chains, but they are linked to the solar capacity installed by the end clients of Annapurna, also on the construction of resilient housing in cyclone-prone areas, and also the enrollment of women into an entrepreneurship skill building program. So we've also provided technical assistance to Annapurna to, first of all, define together these KPIs, and the idea is really to keep providing technical assistance as well to help Annapurna meet these KPIs. And so, as I said, it's not directly linked to agri-value chains, but what we will really like to do, and our goal is to replicate this type of sustainability-linked loans with other FSPs or potentially even Annapurna in the future, with KPIs on sustainable agriculture or outreach to smallholder farmers, for instance.
Thanks. So we've got examples here where an institution is given a financial incentive to achieve objectives that have been set. And as you said, these objectives can be are defined with the institution, so they could be related to the agricultural to strengthening the agricultural value chains. Let's move on to more kind of the focus on the types of TA. So within SNUP, the program that we coordinate, we have 4 types of TA projects that we can finance. The first one is developing financial services, so whether that's credits, loans, insurance products. The second one is to provide and develop non-financial services, so whether that's technical support to farmers, whether that's consumer education, certification, and so forth. The third one is what we call market building. So market building is projects that create linkages between the value chain actors. So for example, it could be creating a platform that provides a link between a producer organization with an input provider using a financial institution. So really kind of creating those linkages, making the value chain more efficient. And the fourth one, which has been a lot of debate in our program, is what we call internal management. And so it's projects that focus on the investees themselves, focus on ensuring that they are, functioning as efficiently as possible. So it can be projects that are linked to risk management, things that digitalization of processes. So really ensuring that the investee is able to service their clients best as they can. So maybe Daphne, I'll come to you because I know you've got an example of this market systems development approach. I just wanted to see if you could just give us an idea of what it really is, and see whether we can create linkages with the investors.
Yeah, sure. Thanks, Matt. So as I said earlier, we really look at value chain strengthening through a market systems development approach to really identify the bottlenecks within the system that hinder improved production of smallholder farmers. So what we see on the screen is the MV4, so Market for the Poor donut or bagel, or everyone has their own connotation with it. So we see that there's 3 main components, and the first one, and that's where we all often work in, is the core transaction. So that's the exchange of goods and services. So we also have the sphere of rules and regulations. So that's the economical, political, and social context in which value chain operates. And then you have like the supporting functions, which is like the information, the infrastructure, the skills, the technology, services. So we're talking about irrigation services, transportation, and also credit. So creating access to relevant and affordable and high-quality supporting functions can really transform the core of the transition of the market exchange. So in our programming, we focus on the one hand also on the rules and regulations, but the focus on capacity building within the supporting function sphere upon market needs and demands is where we truly see the largest impact that can make on the value chains. So we do that through, of course, again, through a thorough market assessment and continuous learning, because it's so vital that you understand the overarching market functions and where it supports or hinders the success of smallholder farmers. Next slide, please. So had the common challenges for rural farmers, what we see, and these I think we all know. So we're talking about like the inability or unwillingness to purchase quality inputs, the low availability or lack of funds, low productivity of crops, lack of connection to input providers. So the list goes on, but it's of course very specific to the market system and each value chain. So next slide, please. Yeah. So to tackle these, we intervene through 2 different pillars. On the one hand, we do value chain development, and then we're talking about really the capacity building, the influencing with the rules and regulations sphere, so with the government. We're talking about connecting, creating market linkages. And the other pillar is access to finance. So that's also, again, capacity building, but also making investments within microfinance institutes. So we bring together the resources and stakeholders needed in farm production. We link marketages, and then we build producer organization capacity and financial service providers also to really spark that market change. What we see is that for most crops and value chains, the access to sufficient and high quality, affordable inputs remains a major challenge for farmers seeking to pursue their farming as a business. So in our STARS project that I mentioned before, we partnered with 22 MFIs to really seek and develop innovative crop-specific financial products for smallholder farmers. And then we also developed the capacity of these local MFIs to enhance their risk management, because what we said earlier, rural is very risky, or at least assumed to be very risky. So we also support them in the business plan development and the capitalization through deposit mobilization and international refinance. We helped by introducing an ACAT tool, and this is a tool that helps both farmers and MFI loan officers to really systematically develop an inventory of the inputs needed for a certain crop, adapted to the area where the farmer intends to farm or is already farming. And we help with the financial planning for disbursements and repayments. Next slide, please. So I'm bringing in 2 case studies from Senegal. We've been working in Senegal in an onion value chain, and where we really saw that the access to sustainable technology to support their production was very difficult. There was a high cost of fuel for their irrigation, and there was high startup costs to make that shift to sustainable technologies. So we ended up networking and negotiating with MFIs, but also together with solar equipment suppliers, to develop a tailored loan and a solar equipment package for the irrigation of this specific onion crop. So this product was specifically designed for these smallholder farmers in that specific area, enabling them the access to this affordable technology. And then again, the repayments were also tailored to the agricultural cycle of the crop, which is very important. So we had some great outcomes. So I also want to show the second. Yeah, there we go. So in Senegal, we also worked in the cowpea value chain. And this case actually highlights the relationship and the forming of agreements with the actors who operate in the rules and regulations sphere that I mentioned earlier. And it shows that also changes in your production, what these changes do in the other parts of the value chain or in the market system. So in Senegal, the seed development was in the hands of the government. So they really develop old varieties of seeds. But we needed, adapted and like climate smart seeds. So we had to facilitate agreements between the government, individual producer organization, and also a network of producer organization, so that they can take upon this role of the seed development. And we actually succeeded in this, so they can also introduce the new seed varieties. At the same time, we also helped to build the capacity of these producer organizations to really improve the quality of the production, and also about the harvesting and the post-harvesting production, post-harvest handling, sorry. So it really increased the volumes of the production, and well, it helped also to enhance climate mitigation because of the new varieties, food security, and also a positive outcome for women, because women are often the ones who are growing cowpeas. However, what was interesting is that this increased produce, it was very difficult for the producers to find their markets. So we had to find a solution for that, because what do you do when your farmers cannot find the markets for your produce? So we organized a business-to-business event, and there was the Association of Bakers. And bakers in Senegal, they faced very difficulties with finding their wheat or their inputs, so their traditional wheat flour. So during the B2B event, we really saw, okay, this could be a good solution for the bakers, the cowpea flour. So, you have to try to find different things in the market system, and that's why for us it's very important to look again at value chain strengthening through a market systems development approach.
Thanks, Daphne. And in this systems approach, when you were designing it, did you involve investors at any point in the process?
Investors,
as in like these ones.
So often we work with grants, right? So this was a MasterCard Foundation who funds programming, and then part of our fund we then invest in microfinance institutions. So the MasterCard Foundation in that sense is an investor, but we also sometimes look for ways, okay, how can the funds that are going into those microfinance institutes, how can they be backed by other larger investors? So yes, we do also work with other investors. Yeah.
Okay, so that's interesting. Maybe coming back to this kind of more holistic bottom-up approach is very needs to be contextualized to the market or to the context within which it's operating. So there's no like one silver bullet, one type of project that's going to kind of solve all the solutions. And coming back to my point about internal capacity building and ensuring that these organizations, these value chain actors are working efficiently. We've got another example from Grameen. Again, it's not entirely linked to value chains, but I think there are definitely kind of opportunities there in terms of finding organizations that have potential and that are potential investees of impact investors, and then bringing them up to a new level. So, Violette, do you want to tell us a little bit about the
Sure.
facility?
Thank you, Matt. So I'll be presenting a multi-year technical assistance facility that was funded by the French Development Agency. So it was called the African Facility. And it was TA facility really focusing on small MFIs in sub-Saharan Africa, tier 3 MFIs, with a strong presence in rural areas. And so why did we develop this TA program? Going back to your point, Matt, is really because we realized we wanted to finance more MFIs in rural areas, and particularly in sub-Saharan Africa. But what we realized is that many MFIs were not complying with our investment criteria in this zone, and especially such small tier 3 MFIs. So we designed together with French Development Agency this program with several components, a guarantee component for us to guarantee our portfolio of loans towards these MFIs, and a line of credit as well from the French Development Agency for us to then on-lend to the MFIs, and very importantly, a grant component as well to really strengthen the internal capacities of these MFIs. The idea was, the ultimate goal was really to strengthen them and to allow them to grow, to improve their financial and social performance, and ultimately to comply with our investment criteria after the end of the program. And so if we move to the next slide, please. So after these 8 years of the African Facility Program, we've tried to do with Cerise an analysis of the performance of the program, the strong points to improve, and also to try to see what was the impact on the FSPs. So maybe first thing to say is that we have to remain, I think, modest, because evaluating this impact is hard. Of course, there are a lot of potential other external events that can have an impact on the performance of these FSPs, and it remains very hard to, see what is the impact of TA per se versus these other potential external events or factors. But globally, what we can see here on this graph is that if we look just at one KPI, which is the operational self-sufficiency of these MFIs, we can see that from the start of the program in 2013 up to 2019, we had quite a strong improvement of the OSS ratio of these MFIs benefiting from the program. Then, of course, COVID came, and we can see that it decreased. But most of these MFIs are now back to their pre-COVID OSS level. So, yeah, in a wrap, the idea was really to strengthen these MFIs, and as I think it was said also by the other speakers, to also work on the institutional strengthening of these MFIs, because that's a prerequisite to invest for us, and also I think a prerequisite for these MFIs to then have the good basis, strong basis, and then be able to develop innovative products and potentially go also more into rural areas.
So this is another example of how combining not only investments with TA, but also having a guarantee fund as well can help achieve the results that we want to achieve. Not dissimilar to Arcelia as well. Magdalena, you're going to give us a few examples of how you've implemented some TA that has been able to de-risk some of your investments, mostly in climate change adaptation. Do you want to take us through some of those examples?
Sure. So, yeah, I think it's becoming more and more a key topic when we talk about strengthening agro-value chains to help organizations cope with climate risks. And in particular, so, agricultural output could decline as much as 30% in the coming years. So this is something that is really relevant for us. And here I've got 3 different examples. So one is related to MFIs. So how can MFIs help smallholder farmers cope with climate risks? And what we developed with 3 partner MFIs in Nicaragua is an agroclimatic insurance scheme to protect smallholder farmers from both catastrophic climate events, but also medium-scale climate events. And this is a pretty innovative product for several reasons. Well, it's a parametric, so index-based insurance that activates automatically based on satellite data, which allows for the premium to be much more competitive and to access maybe far more remote areas. But another aspect which is pretty innovative is the fact that this is not a micro insurance type of product. This is a meso level type of product, which means the MFI is actually the policy holder of the insurance. And what they do is that they insure part of their agricultural portfolio. And through the TA, what we did was that we made a thorough analysis of how the portfolio of the MFI was impacted in terms of which crops in which areas are more vulnerable to excess of rain or drought. And based on this information, the MFIs insured a portion of their portfolio. And this was back in 2017-18, and since then, this insurance has already triggered more than 5 payouts for up to more than $1 million. The project is in Nicaragua, so actually, since the insurance has been out, there's been at least 3 hurricanes. Which have severely impacted smallholder farmers. And thanks to the fact that the institutions were insured, they were able to provide their clients with some help. So basically they condoned most of the loans that the smallholder farmers were owning to the microfinance institution, and they also can provide some relief aid just after the event hits. And another good thing about the meso-level model is that it allows to cover really smallholder producers which would not qualify to a traditional insurance scheme because they have a really high basis risk. So through this model, we can actually reach the most vulnerable ones. And I think it's another really interesting thing is that, yeah, we partner with MFIs to work as aggregators of agricultural actors. And this has a huge social impact, but it also has, it makes a lot of business sense for the MFIs. It allows them to have a less risky agricultural portfolio and to kind of keep expanding and serving the sector, even though the level of risk related to climate is really increasing. So we consider it a huge success, which is why we're actually replicating right now a similar project with a client in Bolivia who's also looking forward to insure some of its agricultural portfolio. And then there were other two projects that I wanted to talk about, which are this time really linked to SMEs or cooperatives. One of them is in Bolivia. It's an SME that exports quinoa and sources from smallholder farmers, which are located in the high plateaus of Bolivia and are also experiencing declining yields and risks based on extreme weather events. So we developed like a comprehensive TA program to implement good agricultural practices that were in line with organic quinoa production, but that would help them adapt to climate change. So this means pest and disease control techniques, live barriers, the development of seed banks and seed varieties that were more climate smart. And we combined this with the installation of meteorological sensors in 2 of the communities where these producers live. And these sensors can provide early warning alerts to the producers through their smartphones, combined with advice on how to deal with what's coming. And for example, last year, actually, producers received an alert saying that there were going to be really strong winds and with an advice to delay the sowing activities by a couple of weeks. And most producers were able to do this. And the ones who actually had to plant the seeds immediately actually experienced some losses because the winds materialized. This was really interesting experience because we partnered with a company that was actually specialized on early warning alerts for really big agribusinesses. And this was the first time that they were working with smallholder farmers and more specifically with quinoa. So they were actually pretty excited to be doing this project, and they partnered with the research institute afterwards once the TA project was done because they want to learn more about what type of specific advice you should give to quinoa producers in regards to changing climate patterns. So this goes kind of beyond RTA, but it creates this linkages between actors in the value chain that are ultimately going to support the quinoa farmers. And the last project is also in Latin America, so in Paraguay, with a sugar cane producing cooperative, Mandubirá. who was also experiencing some declining yields because of climate change, mainly due to droughts, very severe droughts. So through the TA, they managed to test new seed varieties. They also built a soil analysis laboratory in their facilities. And so after trying different seeds, they choose one seed variety that was really climate smart and much more resistant to droughts, and they started to plant it. And it has been also a success, so the seed has brought like 33% productivity increase, and when the project ended, there were about 30 hectares planted with this seed, and a couple of years later now there's 500. So producers are really appreciating the new variety, and it's been helping them cope with increasing droughts. Yeah, so I think this gives you a good panorama of the type of interventions.
Yeah, it gives a good overview of the types of projects that can be implemented that de-risk not only at the smallholder level but at the investee level and enabling additional investments. I'm just looking at the time and want to pass it over to the floor to see if you guys have any burning questions that you want to ask our panel. Yep, Pranav. Thanks.
Thank you to the panel and the remote one for all the inputs provided. I'm Pranav Prasad from the ILO. Just a few quick comments, primarily for my understanding on the first part of the presentation. So we heard a lot of discussion around, you mentioned social and environmental factors that are being accounted for. So I wanted to understand, how do they find reflection in the investment of the work for what your aggregating partners do? I mean, how do you ensure that they are followed, or what parameters help you decide that? And in addition to that, we seem to be talking about the agri-value chains as agri-value chains, but we know each crop is different and each crop has a different kind of set of players and different mechanics in it. So while deciding investments, while deciding work, how are these differences accounted for, and how do you decide that, okay, we'll go for bananas and not cocoa, or whatever the difference is? And in the same ambit, because it's investment and there is a full-fledged parallel agri-finance value chain, how do you align the interests of the agri-finance value chain and the agri-value chain in that sense of the term? I don't know if it makes sense, but I'm just trying to understand the financial flow and the production flow. How do they get aligned in the investments? Thanks.
Thanks. So who wants to go first? Maybe I'll, Jean-Marc, do you want to do you want to answer the question about how to choose your value chains? Can we have Jean-Marc on the screen? He's gone. Jean-Marc, did you hear the question? Yeah, it was more the second question.
Sorry. Yeah, absolutely. Well, truth is, most of the money provided by financing organizations is going actually to the more formal value chains, okay? Because that's where you have less risks, you have more established borrowers. I won't say it's the low-hanging fruits, but that's where basically most of the money will go. The challenge really is to channel some of that money onto the informal, more esoteric value chains where things are less formalized, where you have less established players, where you have more risk, but from a social and environmental point of view, that are probably even more deserving. And let me just take one example. Coffee and cocoa are traditionally kind of male-dominated value chains, whereas if you take more informal value chains, that may not be the case. So there, you have kind of a gender lens approach that is even more pronounced when you start financing these. Obviously, it comes with additional risks, and this is why you need to have a panoply of tools to help you mitigate those risks. Technical assistance, of course, is one, the use of guarantees, and really, ideally, I know one of the questions is, okay, what's better? What works better? Well, the ideal is that you should use both because they work best when combined. And you have, my colleagues on the panel have given a lot of examples of technical assistance projects that they implemented following the identification of weaknesses during the life cycles of the investment. This is something that can be done ahead of an investment to prepare for it, but this is also something that can be done when you have catastrophic force majeure events, such as a pandemic, for instance, and where you can tap on the technical assistance budget to provide an ad hoc solution at that point in time. And you can do that also whilst working with other lenders. We have many examples of lenders groups solutions using technical assistance to engineer a restructuring for the benefit of a microfinance organization or an agri-SME, and to help basically the ultimate clients and farmers to continue their activity.
Violette?
Yeah, maybe if I can add on the selection criteria for value chains. So we're working at our level, we're working a lot on technical assistance to strengthen value chains through the SNUP program that Matt presented. So the program, and maybe you can add on that, Matt, but the program actually has selection criteria for the value chains. And I think that goes back a lot to what Jean-Marc was saying, that we are trying to target value chains that are not only the big value chains with an export potential, but we are also looking at other factors such as the impact on food security in the country. We're also looking at the number of smallholder producers that are going to be impacted. I think that's a very important criteria for the SNUP. And we also try to have this gender lens, which is not always easy, but we try to look at the presence of women within the value chain. So we just wanted to add on that.
Thanks. Did any of the other panelists want to take on any of the other questions? Do you feel your questions was answered? No, by the look of that.
Actually, it became 3 questions, so sorry about that. So we've got
one out of 3.
Yeah.
Okay.
Agri-finance and the agri part would be interesting to understand.
True.
So I think another question was how to align interests of MFIs and agro. Right. Yeah. So on that one, I think actually we've got some projects where we want to support MFIs in expanding their activities in the agricultural sector, but to do so in a really responsible way. And we really take a lot of care in working with experts that are not going to find only like profitability avenues for MFIs, but also to define key risk managing processes that are really linked to the payment capabilities of the future clients. And so that to do so, we, for example, can carry out specific market studies or do work on the development of tools that are going to automate the risk, that are going to provide some intelligence for the loan credit officers to be able to assess correctly the payment capacity of the clients, and also sometimes provide a lot of training to loan officers on responsible lending practices and on how they can better address the needs of their final clients, so that we're keeping both interests aligned. And I think the agricultural insurance is also an example of how you can both protect the MFI and the smallholder farmers.
Thanks. David, did you have your hand up?
Thanks a lot. So unfortunately I entered a bit late, so I'm sorry for that. But I'm interested to what Magdalena explained, and in particular in the case of Nicaragua. I have one question and one reflection. In terms of question, insurance in Nicaragua, I remember long ago, I mean maybe not so long ago, but 7-8 years ago, Fondo de Desarrollo Local tried to build up an insurance on agriculture with the Comicro, with the Inter-American Development Bank, and finally they didn't manage, so it was a project on a specific finance to adapt to climate change with better practices and then on specific value chain, and then insure the risk. And they have some technical problem to set up the insurance, so finally the project went without insurance. I don't know if you know if there was any evolution in Nicaragua, because it was really a problem by state, government, etc., to be able to use this kind of insurance you are discussing back in time. Maybe you were not involved, but that was my very and then inside the other reflection, I wanted to know if the insurance is covering just events that you are describing, like hurricanes, etc. That no matter what you do, you're going to destroy part of your production, or is also covering other kind of issue like prolonged droughts or prolonged period of not rain or oscillation, etc. And if you do that, if you have been or you are considering to have a different premium in terms of the practices that are put in place with the same value chain. For example, you have a production with a good structure agroforestry in cacao, and you have a one that basically studies traditional chemical and with 2 trees on the farm, that of course they're exposed to different level of risk to prolonged droughts or other stuff, but probably similar risk to hurricanes, because of course if you have a hurricane, you have a hurricane. So thank you.
Thanks for your question, David. So I'm not sure about the regulatory obstacles you were facing back then, but I know that the consultant who worked with us, and actually the reinsurer of this meso-level model is AXA Excel, and we partnered with MG Consulting to kind of help with the product development, and she undertook a long haul work with regulatory authorities in Nicaragua to manage to get the product approved, and it worked. So yeah, I don't know if your specific product had other type of difficulties. Regarding the type of events that covers, yes, this actually the insurance is really interesting because it is not exclusively focused on catastrophic events. It also covers medium magnitude climate events. So basically, and actually the indexes, so it's parametric insurance, so the payouts are automatically triggered when you reach a certain level of precipitation, so either too much rain or too little rain. But actually, for each crop that is insured, you get different levels. So when we were working on the product development, we hired an agronomist who developed like sheets of actually water needs for each of the crops insured, and based on these needs, in each region, you get a different index. So if you get coffee in the south of Nicaragua, maybe it's going to need a bit more water than coffee in another region of the country. And so actually the indexes are really tailor-made to the need of each crop and each region in the country, which actually helps us cope with that risk of, sometimes parametric insurance has a level of precipitation, but actually the producer is seeing some degradation in his crops even before you reach that level. So by doing this tailor-made product, we reduce this reputational risk with smallholder farmers. The problem of the mesa level is that we cannot change the premium in function of the practices that farmers implement, because the insurance policy is one for the MFI. So the MFI is just going to pay the premium and then distribute it according to a protocol. But with this mesa level, you cannot make the different risk assessments according to the practices that each producer is implementing. So, yeah. I don't know. I don't think we've been faced with that situation, but it would make sense, but I don't know.
Yeah, go. Yeah. Okay, we've gone over time.
So the risk of the organization is taken as a whole. So the pricing would still be one.
No, but there are two different organizations saying it. One institution that has 50% agroforestry and 50% plants. Yeah, exactly. And then another one is that it's 20 and 80. That should have price B, because the portfolio one is.
So there will be different. Depending on the risk space from each of us.
The question is, are we considering that in an insurance?
I'm not sure there are so much products and examples on agroforestry for the moment.
Yeah, correct, yeah.
Well, so this is good. I like this debate. We are running out of time. Well, we have run out of time. I'm not sure I do, but yeah, go on. One more.
Don't worry, I'm going to get us off track.
Okay.
Oh. So, because different subject. On the collaboration with NGOs in technical assistance. So my experience over the years is that impact investors get involved at a very late stage. So programs have been developed, have already been implemented. And then there's a question for impact investors to actually invest. What we often see is that actually there's a misalignment with what has been developed and what we need as an impact investor. So some self-reflection for impact investors, and the question then is, what do we need to do to get in an early stage on the table to design programs which are indeed in the end beneficial to MFIs and cooperatives to provide finance?
Shall I answer?
As the non-investor.
Thank you so much for the question, and I fully agree with you. And you know, that's often like the game that we as NGOs, of course, have to play, is that we're very reliant on development programming that is out there and the development funding that we need to tap into, and that the donor have some certain ideas and we have some certain ideas that the funding comes available at a certain time, and then you tap into it. But then, of course, it's much more beneficial indeed, as you say, for the whole market system if you start from scratch and if you negotiate with your, on the one hand, your donor and the impact investors and MFIs at the same time. So within our STARS project that I described, we started with the MFIs from day one. And we were active in these countries already before, so with this MFIs we've been working with. So talking about like impact investors from a higher scale to realize also like refinancing, they come in a later stage. So I fully agree with you that we have to do that from the beginning. But again, sometimes your hands are tied because of development programming, and there are own agendas. So
Okay, so I'm going to close the session there, but if you do have other questions, you can quickly, get to them. I think, just as a conclusion, I think, creating those linkages between TA and investments is key, and it's something that I think just needs to be conscious about, needs to be reflected on, taken on board into when designing programs. So I'm going to say thank you to the panelists, thank you to Jean-Marc, who's somewhere out there, and. And thank you to you for joining us, because I know there was some other sessions that was there. So thanks very much. Thank you.
Thank you all.